Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss is gold a safe haven? It depends on the country.
Hello everyone, my name is Radovan Vojtko and I'm CEO of Quantpedia. Today's topic is gold, or investing and trading with gold. So gold is a favorite asset for all of the people that are worried about the future. Sometimes they are called the gold bugs. I'm not a gold bug personally, but I understand that the gold can be a viable part of the portfolio and can use it from time to time as a hedge against some geopolitical situations. I will show you a few examples of research papers and blogs that are related to gold and to investing into gold and trading with gold. The first question is the gold really a safe haven asset? So it really depends in which country you locate it, and then it depends because the gold can be, usually is not the safe haven asset. The paper written by Dirk Bohr in 2021 presents his research on 68 stock markets and gold in local currencies and in US dollar, and he compared what is the performance of the gold in local currency in each country during some geopolitical situation. What he found out, it really depends on the countries. I will later show you the list of the countries in which the gold is market hedge or hedge against the events. Here we have an example of the performance of the gold in Australia. So the black curve is the performance of the equities. The lower yellow one is the performance of the gold in US dollars. That's the case of the global financial crisis in 2008. So in 2008, we can see that equities went south like 30% between 2008 and 2009. Also between September 2008 and March 2009, so all of the Lehman Brothers moments and all of the bankrupts of US banks, etc., etc. And we can see that the US gold hardly moved at all. But when we compare the gold in Australian dollar, we can see that price of the gold in Australian dollar performed as a hedge against this event. So it means that for somebody from Australia, the gold could be as a hedge. The reason for that is because at the same time when there were stress in US equities, US dollar was outperforming against the other currencies. So the other currencies, they were losing the value. So when you had the money in a gold, you were gaining the value. It was not mainly because of the gold, but mainly because you were holding the safe currency. So not just the US dollar is the safe currency, but also the gold can be the safe currency in the case of Australia. Let's take a look on a COVID event. So the COVID was in 2020. Once again, the equity market in Australia went south, lost like 25%. At the same time, the gold price in US dollars and also the gold price in Australia dollars went up. What is the most important figure from that paper? It's the figure number 4. It shows the correlation of the stock market in local currency with the gold in local currency. So when we have the small correlation, it means that in these countries the gold can work as a hedge in case of the bear market in equities or in case some global imbalance or global geopolitical situation. In which countries the gold is not a hedge? It's Venezuela, Egypt, Peru, Argentina, Hong Kong, China, Japan. So these are the countries for which the gold is not performing as a hedge. And what are countries in which the gold is performing as a hedge? So it's Australia, Brazil, Hungary, Spain, Greece, Poland, Norway, Chile, Italy, France, Cyprus, Romania, Austria, Sweden, Bulgaria. So it's mainly European countries, nearly all over the world. How does it look like for the US? So US has a positive or slightly positive correlation between the price of the gold and the US market. So it means for US the gold is not hedged at all. But for other countries the gold can be hedged. So is gold really a safe haven asset? Yeah, it is for some of the countries. It doesn't have to be for the US, but for all of the countries around the world it can be a nice hedge. Now, what is the optimal gold allocation in your portfolio? There are the people who recommend, 30-40%, etc. It's usually too much. We can take a look what is the institutional holdings. So allocation varies across time and institutions. On average, the gold holding institution has a gold exposure of around 1.7% or 2%. It really makes sense. I mean, it's store of the value and hedge in case of global imbalance. But 40% is probably too much. Should we invest in the gold or gold-related stocks? Now that's a topic of another paper. Once again, gold is considered as a hedge and it's recognized for ability to preserve the value in the long term. But gold is not the only gold-related investable asset. We can buy gold-related stocks. So producers of the gold, explorers, developers, etc. The common sense might suggest that the price of such stocks should reflect the gold prices, and you can maybe even earn more money holding these stocks. But the research from Bohr and Trench from 2020 shows that that's not correct logic. So research suggests that gold equities cannot be considered as safe haven assets. Investors differentiate between producers, explorers, developers, and gold. During the stressful period, it's better to hold the gold than gold producing stocks. So here we have a chart from 2020, gold companies share price, gold price. So we can see that the gold price is a blue one. It's really outperforming gold explorers, producers, and developers. All of them were not performing very well before the COVID market and also during the COVID market. There is one more thing that I would like to show you. This is the picture from Wikipedia, so you can show it very easily by yourself. It's the price of the gold compared to inverted 10-year treasury real return. This chart just shows that what is the really important factor for the price of the gold. It's a real yield on US treasuries. So we can see if 10-year treasury return inverted goes up, the price of the gold goes also up. If the 10-year treasury real return goes down, as in case in 2022, or I don't know what's case in 2014, when the interest rate went very steeply up, then the price of the gold usually goes down. It's very important to not just focus on what is the actual price of the gold and what is the geopolitical situation, but also to take a look at what is the treasury real return. Thank you very much for your attention, and I hope you will join me in the next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.